So, right, banks, when they're looking at picking up a loan for a vehicle, they're going to say, well, what is the loan to value ratio? How much money are they trying to borrow versus how much is if it's a new car, how much is the invoice for this new vehicle? So they'll be willing to go sometimes 130%, 135%.
Whoa.
Yeah, if you've got good credit, they're like, sure, take on all the debt, right? But so what you have to do in order for, if you have more negative equity, the dealerships really are the ones that are coaching people into, well, hey, you can't just trade straight across. You need to get a little bit more expensive vehicle so that loan to value comes in line, so the bank will even pick up your loan. And that is a symptom of the people not having the cash to pay down that loan themselves, right? If they're relying on the manufacturer's good graces of a good rebate, and the bank's just saying, sure, we'll pick up the loan, just make sure it's an expensive enough vehicle, it's a bad storm.
What does it do to the car payments?
Oh, they balloon.
Because they still have to pay off whatever that negative equity was.
Yep.
Then on top of it, you have the new car loan.
Correct.
How in the world are people even qualifying for that?
I think it's something that you've talked about where banks loosen financial policy, and that's going on right now too a lot with this whole economic climate, we could say.
Oh, yeah. Yeah. Because what we're seeing is that the underwater car loans hit a 4-year high, and they've been constantly growing. And that really is a sign of distress,
Yeah.
right?
Right, absolutely.